Hi folks, I'm Ming from Volition Properties, where we help you make smarter real estate moves. Let's talk about these rate cuts, both in Canada and the US, and what they really mean and how they affect your decisions in the real estate market here in Toronto. So, high level, there's been cuts, right? We've got a 0.25% cut in Bank of Canada, and the Fed's also down 0.25%. Face value, you got lower borrowing costs, so if you're on a variable rate mortgage, but let's be real, it's not going to change the math for most people. They're still going to be stuck with relatively high mortgages, and you're unaffected if you are in a fixed rate mortgage. What's more important here is the underlying message, like why did these rate cuts even happen? And more importantly, we should be looking at the messaging with the rate cuts. Starting with Canada, it's not a good news story. Growth is slowing, household spending is soft, the job market's weakening, unemployment's been climbing, and inflation is still sticky but easing. So that's why they're cutting the interest rates. Not because they want to give you some deal on your mortgage, but because they're trying to protect for the impending slowing of the economy. Same story in the US. Job gains are slowing. Their unemployment is also kind of in a more troublesome situation. Their inflation is still above their target levels. However, they are signaling for more rate cuts in the future. Bottom line is both economies are slowing right now, and these cuts are about cushioning the slowdown, not celebrating strength. So be careful as to how you're reading these cuts. So what does this mean exactly? This is what we really like to do at Volition, is take not just the news, but how does this distill down into action? So right now, it's been a fantastic time to buy. This year, 89% of our business has been on purchases. Either people taking advantage of the softer market to secure some really good deals on personal residence. Many of those folks have been climbing the property ladders. If your townhouse is down 10%, but that big detached home is also down 10%, on an absolute value basis, that's more money off your expensive properties. Of course, we have to have a personalized approach to this. You can't have both a good market to buy and a good market to sell. Let's be real. So in general, it's not a great time to sell. Yes, we've seen uptick in activity in the last couple of weeks, but I do believe it's a blip. People were trying to get in before the rates dropped because they felt that the 0.25% drop was going to spur more market activity. And that's simply not the case. We are in a slowing economy. I do believe that the softness will continue. And if you are looking to sell, come talk to us, because there are potentially a lot of other options to just simply selling your home. For investors, it's been, again, a fantastic time for investors to grow their portfolios. Cash flowing properties are here in Toronto. They have been for 6 to 12 months now, which is a rarity in the city. It's always been very tough to find cash flowing properties. Land for development. A lot of developers were getting in, but they were using risky lending structures, private lending, really expensive. We never encourage that kind of stuff for our developers, and they are now able to take advantage of lower prices without having to compete against some of these other developers who have taken much more risky financial structures to fund their development. Also, there's government incentives, CMHC, MLI Select programs. And while it's a great time to buy, and most of our clients are buying, it's not always the right time to buy. I mentioned 89% of our clients. There's that 11%. And if you're interested in understanding why you shouldn't be buying, click on the link that we have, because we talk about when that 11% matters. Thanks very much.